Hello, this is Chuck Stull. I'd like to start this week's class by looking at a transportation problem of iron ore in Western Australia. Now, Australia in general has many minerals. What I want to look specifically at is the Pilbara iron ore deposits in West Australia. So to the far left of the map, the kind of beige circles are the iron ore deposits. So we're looking at a very remote area of Australia, um, essentially very small population and little industry. And the problem I want to look at is taking um, iron ore from the mine where it is um, dug from the ground and having it sent to the nearest port where it is loaded on ships for export. So in this case, that port is Port Hedland um, on the coast of Australia. So our focus for this problem is on transporting ore from the mines. So these are the square dots shown on this map, the red dots, and then the blue ones are the expected opening ones, up to Port Hedland on the coast. Right? So in the very um, northern part of Western Australia. So we're looking at just that specific transportation problem. Now, one mode of transportation that is possible would be to use trucks. So the trucks could be loaded with iron ore at the mine and driven to the port, um, and certainly very feasible. The problem with this is that trucks are expensive. Um, Maybe $14 to ship a ton of ore 100 miles by truck. And that doesn't leave very much profit margin for the mine owners once we take into account their cost of production. So certainly we could look at alternative means of transportation. Now railroads are very efficient means of moving bulk cargo. Um, they have some really big economies of scale and their operating costs are much cheaper. So perhaps instead of the $14 per ton for 100 miles that it would cost by truck, trains might have an operating cost of $1.36 per ton. Right, so the train seems very attractive. But one thing with trains is we do need to consider the cost of constructing the track, and that is really very expensive. So railroads have high fixed cost, which we talked about in our very first week of class. So to produce 100 miles of railroad track could cost anywhere between 100 and $200 million. So let's look at the upper end just to be conservative and consider, is building a railroad a good investment? And that really depends on a couple of things. So is it worth spending $200 million on 100 miles of train track? It depends on the amount of ore that's being shipped and on the lifetime of the track. So these mines in Western Australia have had an average annual production of about 26 million tons per year. So it's a high volume. And all of that iron ore needs to be transported to Port Hedland. And the lifetime of track, if we base it on a depreciation schedule, seems to be about 10 years. So if we take our $200 million cost for 100 miles of track, divide it by 10 years, we get about $20 million in annual cost. And that doesn't look too bad. If we compare the $20 million in annual cost to the $26 million in 26 million tons, right, our cost per ton looks pretty reasonable, or average fixed cost looks pretty reasonable. So we can calculate that by taking our $20 million in fixed cost per year, dividing it by our 26 million tons of ore shipped, and it gives us an average cost per ton for that 100-mile distance of just 77 cents to cover the cost of the track. Now we talked about the operating cost earlier of $1.36. And so if we want to calculate the total cost per 100 miles, or the average total cost per 100 miles, we could add the fixed cost, the average fixed cost being the cost of the track divided by the amount shipped on it, plus the average variable cost, which would be our operating cost. So our average total cost in this example is 77 cents plus $1.36 for a total cost per ton per 100 miles of $2.12. Right? And that is much, much cheaper than the truck, which was costing $14 to ship a ton the 100 miles. So the railroad is much cheaper. The train track is a worthwhile investment. It saves resources by operating more efficiently and saving cost. But there is a problem. With trucks, it's possible to have many independent firms with a competitive market structure charging at marginal cost, for pricing at marginal cost. But with a train, we only have a single firm. We have a monopoly. And so this is a familiar problem. We have economies of scale leading to lower cost, but we have monopoly leading to high prices. So as a monopoly, the railroad wants to maximize its profits by charging a high price. So we could look at graphing this out with a pretty inelastic demand curve for transportation services from the mines, look at marginal revenue, marginal cost. Or in this case, it becomes much more simpler, is we can say, well, we know the train can't charge more than $14 because then it would go to trucks. So they're going to pick a price as high as they can get from the mine owners, maybe $12 a ton. Right? So undercutting the trucks, the mine owners would save $2 per ton. So that's attractive to them, but the railroads are going to have a lot of profits. So at a price of $12 a ton, the railroad is very, very profitable. They can pay their operating costs, they can pay the cost of building the tracks, and then they will reap millions of dollars in profit over time. The problem, of course, is that mines are only saving a small amount. Nearly all of the surplus is taken by the railroad. Right? And then that, of course, is because of monopoly. Now let's consider, could we change the market structure of the railroad? What happens if we build a second railroad? In that case, each train company will spend $200 million to build tracks, but they're now only going to get half the business. Right? So 13 million tons per year for each company, and that's going to double our average fixed costs. So the railroads will be less profitable, their costs are going to be elevated, they're each going to have lower revenues. Now, the benefits to the mine really depend on how the railroads respond. Now, the railroads can't pass on their cost increase because they've already been maximizing profit based on willingness to pay. Now, if the railroads collude, then there'll be no price decrease, and the mines will still be paying the $12 high price. And we'll have no benefit, we'll just have these extra costs. Now, if the railroads do compete, right, if the new railroad undercuts the other one, then the mines may save money. But as a society, we're going to be worse off by the $200 million that was wasted on the unneeded second tracks. And so that's a really important element of this problem, right, is that even if the mines might become better off, society won't be, because we're going to have a lot of resources used to build tracks that are unnecessary. This transportation issue is really an illustration of the natural monopoly problem. In terms of cost of transportation, the lowest cost option is to have one single railroad. The competitive market with trucks is terribly inefficient. Adding additional railroads to create a competitive market waste resources at the cost of $200 million per 100 miles of track for an additional one and drives costs up. But the monopoly pricing really hurts firms. So in some ways, we have a situation where market-oriented solutions aren't going to solve the monopoly problem. we can't create competition and still keep costs low. So we could consider some alternative solutions that would avoid the high pricing of monopoly um, and still take advantage of the low cost of a single railroad. So one would be vertical integration. If all the mines were owned by a single firm, they could vertically integrate, purchase the railroad, or build the railroad themselves, run it as a subsidiary, and charge either marginal cost or average total cost to get the ore to port. Now, if there are many users, if those iron ore mines are separate, they could own it collectively. That would be a form of public ownership. And there could be a variety of different ways public ownership could take place in this particular example. But public ownership of some kind could again prevent the high monopoly pricing and take advantage of the efficiency of the single large railroad. A third possibility is that we could have a regulated monopoly where we keep the efficiency of having a single cost-effective firm. We keep the efficiency from the natural monopoly, but we avoid exploitive pricing by having the government control prices the firm could charge. This has been Chuck Stull at Kalamazoo College, looking at an example of natural monopoly. Thanks for listening.